Hey guys, hope you're well. I wanted to introduce you to Prash. Chauhan, this is Prash. He's our accounting partner from BBC Accountants, and he not only helps us with all of our accounts for our property stuff, but also obviously helps all of our clients as well. Hi, Prash.
Hey Shiv, how are you? Thank you for inviting me on today.
I'm really
I
good. I
just,
actually invited you for a very good reason because I need your expertise on today's topic. Before we get started, just give us a very brief sort of intro about yourself. When did you start? How did you come into all this, etc.?
yeah, absolutely. So I'm Prash, one of the founders of VPC Accountants. We set up back in 2018. I think Shiv, I reached out to you, it's probably about 3 or 4 years ago now. Obviously, there's a lot of synergy in what you do and what we do, which people don't always see. I specialize working with landlords, property owners. At the moment, we're doing a lot of incorporations. We also work with a lot of we work with all sorts of clients, but we have in particular quite a lot of landlords. And yeah, we work. Like I said, we connected about 3, 4 years ago. We work quite closely as well.
Yeah, exactly. And of course, the reason why I think it really works with us is because people think that, you buy a house and you get your rent and that's it, happy days. But actually, obviously, there's tax to pay on that rent. And there are different ways of structuring the property, which we're hopefully going to go and talk about today. But as well as that, there's also long-term sort of tax planning as well. So as well as like annual tax, how much you're going to pay, also how do you structure it so that long-term it works out best for you as well. So I wanted to just talk you through the scenario that I found myself in, and then we can talk through what the numbers look like. I've got a couple of slides just so that people can follow visually. But
Yeah,
basically, I went for a haircut last Friday, and the hairdresser that I have, he once, I think, I was in the Telegraph a couple of years ago, and he must have picked it up. And as soon as I came into the barber's that week or a couple of weeks later, whatever, he was like, "Oh my God, here we go, property tycoons here." And I was like, "What's going on? Why is he saying all this stuff?" And he had this like newspaper in the back, and he brought it out, and he was like, "Look, you're in the paper." There's lots of people that are, in that room, and we can have these conversations with them. And one of the conversations that I had was with the guy that works in sales. And he was actually stressed at the time he was having his haircut because he was thinking about moving to America and he didn't know what to do. And I just started chatting to him and I said, "Well, tell us a bit about yourself." And a long story short, he's in sales. He earns about 150 grand a year, plus maybe a little bit more in terms of commissions and stuff. His wife's probably on at least 50, 70 grand a year. So they've got, combined income of about 200 grand on a gross perspective, maybe even a bit more than that. And they've done really well for themselves. They live in North London. They've been frugal. And as a result, every year that they've saved up the money, they've taken that money and they've done the right thing, which is they've invested it. A lot of people just put it in their savings account, but these guys have been quite savvy and they've invested that money. And now he's got this opportunity like, oh, do I move to America? Do I not move to America? And it was really stressing him out at the time. And I was just talking to him, I started the conversation. I said, "Oh, do you know, after we chatted about his America exploit, I said, do you have any properties at the moment?" Because he said, "Oh, I'm interested. I want to buy some properties." I said, "Do you have any properties at the moment?" And he says, "Yes, I have I have three properties, 3 or 4 properties actually in the local area in Watford."
yeah.
Um, and I was like, "Oh, right, fantastic." I said, "Do you own them in a limited company?" And he was like, "Oh no, I own them in my personal name." And I was like, "Oh my God, like you must be getting completely hammered on tax." And he was like, "Yeah, like how did you know?" And I was like, "Because it's just maths. Like people don't know these rules, but if you've got your properties in your personal name, then you can't offset your mortgage interest. And if you've got properties with mortgages on them, then you are going to ultimately end up paying a lot of tax." And he said, "Oh, but that's crazy, but I don't know what I should do." And I was like, "It's so simple." And you and I have spoken about this so many times, Prash, and I'm sure that you advise people to do this. But the simplicity of it was, well, what you need to do, I'm going to tell everyone before I show you even the slides and the maths of it, is sell your portfolio, take the money, loan it into another limited company that you set up to invest in, and then buy properties in the north rather than the south because the north will give you better returns. Buy property in the north with that money, and even after paying all the taxes and everything, you'll still be better off with those properties that are in a limited company in the north than you will with the properties in the south. And the aversion that I think that most people have to doing this ultimately, in fact, what excuses do you get, Pressure? Why do you think people don't really go when you tell them that? Because you're the accountant and you tell them that. Why don't they go ahead with this?
First thing's always, "Oh, I'm going to pay too much tax," but and I'm sure we'll see on the slides in a second. But the bigger problem actually is that you're probably losing money every year. A lot of people, even if you're just breaking even, you have to kind of think, is it worth it? Now, unfortunately, obviously, the rules changed in 2017. Each year they slowly tapered it, and you could claim less and less mortgage interest if the properties were in your name. And it's that what's ultimately cost people, and people fear. There's also sentimental value, which you have to remember. This is a business. Everything is up for sale all the time, and I know people sometimes struggle with that, and each to their own. But I think you have to kind of have that mindset. If you're looking to grow a portfolio, you have to have the mindset. It's just another asset. It's just like buying stock and selling it. Um, but first thing's always it's always the tax. Tax is
Yeah.
always at the front of people's minds, and we try to make them understand that, or just try to explain to them that yes, look, there will be tax to pay. You can't really get away from that. If you made a capital gain, there's tax to pay, but you have to kind of think if you're generating a loss each year and you could sell, pay some tax, and then start generating a profit, increasing your portfolio value, is it not better just to draw that line now before it gets too late?
And what
I
you want to
believe,
do is look at these things over, like, let's say a 10-year period, right? So if you're looking at just this year, then yes, you'll pay some tax there. But if you look at this over a 10-year period, you're probably going to
yeah,
be, not probably, you are going to be net positive, within the first 2 or 3 years, you'll have paid off the tax and then some, especially if every year you're making losses.
yeah, and look, I understand there's always going to be capital growth wherever you're buying, London, North. There will always be that element, and people always say that to me as well. So you don't understand my property's going up in value, but you don't tangibly have that. That's not yours, and also legislation's constantly changing. It's kind of been the most secure within limited companies for a longer period. It's just a little bit more secure, but we don't know what could happen if capital gains tax rates go up, IHT goes up. They're talking about either changing the 7-year rule to a 10-year rule. I was talking to Akash earlier, actually. He was talking about they might even look to scrap it altogether,
Yeah,
which
yeah.
is, um, there's just also more flexibility with doing things via a limited company. But we can touch on that, I guess, as we go on.
Yeah.
But
I
there's
think
lots of,
that sentimental value that you said, I think that for a lot of people, it's I've spent ages and I've worked so hard to make this money, and now I have transferred this money into a property, and so the money is now inside that property. And when you say sentimental value, it's I think it's the effort, it's the trauma, it's the pain of having to go through that process and set it up in the first place. And now that I've done it, even though it's loss making, I don't want to sell it because now I feel like I'm losing. And we'll go through these slides so we can have a look at what the actual numbers look like. Let me share my screen. Okay, fine. So here's what we are doing. So from loss to profit, how to turn around a loss-making London portfolio by selling everything and reinvesting within a limited company structure. So we have this guy. His name is Mahmood. Actually, I can't remember what his wife's name was. His partner's name. But he's got four flats in North London. He's got combined income of about 200 grand. He's losing money on his investments. Full-time employed, paying additional rate of tax because obviously past the 100 grand, you pay the 45% tax, not just the 40% tax. And considering emigrating, actually, just he doesn't want to, but he's considering it just for tax purposes. So his current situation is that he's got leasehold flats in North London. This is what they look like. He's got a 300 grand flat, and the mortgage is 225 grand, equity is 75 grand. And we'll talk about it in a second. But when we talk about capital growth, they haven't increased in value nowhere as much as he thought they would. They're kind of ticking along, and I'll talk to you about that in a second. With this property that he's got, the 300 grand property, his gross rent is 18 grand a year. His mortgage interest is 12 grand a year. And his costs are 3.5 grand a year. And that's because it's a flat, he's going to pay service charges, he's going to pay ground rent, all of that kind of stuff. Plus, obviously, the constant sort of management and all that of the flat. So the costs are about 3.5 grand. So his rental profit is 18 minus 12 minus 3.5. He's getting 2.5 grand a year of rental profit, which is, obviously not a huge amount for an initial investment of 75 grand. His taxable profit, though, and this is where it gets really interesting, Prash, his rental profit is 2.5 grand. And I know that we've just been through these slides, and some of these numbers need to change a little bit. But his taxable profit is 14.4 grand, which is 2.5 grand plus 12 grand, because the HMRC count your mortgage interest as part of your income. So 12 grand plus 2.5 grand is £14,400. And then I've said he gets taxed at 45% on that 14.4, but you're saying it's slightly less than that. It's a little bit more of a delicate do you want to explain it?
but not too much more. So basically, if you own property in your own name and there's a mortgage with interest on it, you can claim 20% tax relief on the interest element. So of the 12K, 2.4K effectively will be deducted as an expense. It's reduced. It's a tax reducer.
Yeah.
But
So
ultimately,
I've got here tax at 45% is 6.5 grand. You're saying that'd be a little bit lower than 6.5 grand. So let's just work through this example then. So the loss after tax is 4 grand. I suppose in your example, it would be about 2 grand. But the point is, either way, there's still a loss after tax. He's not making any money. And what that means, of course, is that when it comes to paying the tax, he's got to find that from his savings, from his earnings, from his other investments that are potentially making money.
yeah, I think I know it's psychological, but it's the terminology sometimes as well. Like when we say loss after tax, people just see it on paper, oh, this is my loss. But actually, that's your cash flow loss. That's you're paying that to keep
Yeah,
this running each year.
yeah,
Uh,
yeah.
uh, that's a bit that sometimes people think, oh, it's okay, I've still got the property. But actually, you could, that's a holiday. That's a one-person trip to Dubai.
Yeah, yeah. Well, let's have a look. Like I said, when people say I've still got the property, so the property that they've got, I've checked this out actually. The capital growth on this property in Watford is 3% a year. I'm really savvy with ChatGPT now, so I said, ChatGPT, I've got this property in Watford. How much is it growing at? And it said 3% a year. So 3% a year on this 300 grand property is £9,000. So at least he's making something on the capital growth. And so overall, the annual gain is +9, -4, +5. Cool. They're making some money on it. Happy days. But he's got four of them. So he's not just making five, he's making 5 times 4. He's making 20 grand of annual gain on these across these four properties. It's costing him 75 times 4, basically. So 300 grand worth of money that he has got tied up in these properties, and he's making 20 grand a year on it. Does that make sense so
Yeah.
far?
Yeah.
So 20 divided by 300. So that's a 6% return. Fine, happy days. Then we say, in this situation, because people are making losses, and it's not usually beneficial for them to do this, at this point, you usually give them some advice. What's the advice you usually give them?
I mean, my advice at this point is you should seriously consider actually setting up.
Yeah.
Um,
And that's crazy for most people to hear because they're like, what are you talking about? It's just taking me
yeah.
so much effort and hassle to get all this up and running. And they are, houses that I can touch and I own and I know where they are.
And it's not going to change. We're not going to see, and I can't imagine. I don't believe there will be any change in legislation to make this any better. If
Mm.
anything, I guess it would only really get worse.
Yeah.
As it is, there are stricter rules as well around repairs and renewals. Some things HMRC prefer capitalized. For example, if you had wooden floors and you want to put carpets in, I actually think that has to be capitalized. People think that I can just stick that in as a repair, but it's not like for like.
And what you
Um,
mean by capitalize, just to be clear to people, is that you can't count that as a cost in your profit and loss. So where it says loss after tax, you can't count that in that calculation. It needs to go in the capital on the balance sheet, which basically means that when you go to sell the property, that's when you'll get some tax relief rather than getting it on a yearly basis.
so you get tax relief, but yeah, at the point of sale, which could be, and you have to keep a record of these costs. You have to make sure you have a file. It's all kept there ready for when you do sell. HMRC won't just accept a ticker box and say, yeah, I spent £10,000 on my property. I want to get tax relief on it.
And how many people have, sold a property like 20 years later and gone, well, I don't remember how much that refurb that I did, in 1996 was.
It's impossible. It's impossible.
So what we have is this future situation then. So what we can do, instead of having this leasehold property in North London, we can sell this whole thing, and then buy a freehold house in Leeds. Let's see what that looks like. So the first thing, like I said, is you take the 75 grand equity that you make from it, you then invest that into the limited company as a director's loan. And then it will buy you this property over here, 150 grand property. Now put 75 grand, including fees. I'm just taking like worst case scenario. We buy it, we refurbish it. You've got to pay loads of fees and stamp duty and all the rest of it. But ultimately, you get to buy this property. Now, your mortgages are much lower, 112,500. And what does that mean? That means ultimately your mortgage interest is going to be lower as well. Your liability is lower. On this property, your gross rent is not £18,000, it's £12,000. Your mortgage interest is £5,000. It costs £1,500 because it's a freehold. And so as a result, your rental profit is £5,500. Now, just to take you back to this scenario, your rental profit was 2,500. So you're making 18,000 rent, but you're only making 2,500 rental profit. Now you're making 12,000 rent, but £5,500 rental profit, which is a considerable difference. And then if we look at the next bit, the taxable profit here is £5,500. and you get taxed corporation tax, not income tax. So because it's within a limited company, you're investing this through a limited company, you're getting the 19% corporation tax, which on 5.5 grand is just over £1,000. Let's call it £1,000. That means your profit after tax is £4,500. And again, let's just go back over here. We said the profit after tax in this scenario was between £2,000 and £4,000. And over here, we're now saying it's £4,500. So you're doing, sorry, the profit after tax here is negative. It's a loss after tax between £2,000 and £4,000. And over here, it's a profit of £4,500. So that's already like a what's that, £6,000 to £9,000 difference.
Yeah.
Then this property that we have, this freehold house, not a leasehold flat, is going to have capital growth at 7.5%. Again, I asked ChatGPT what's the average capital growth in this property. 7.5%, £11,250,000 on this £150,000 property. As a result, your total annual gain on this property is £15,750. So that's the 11.25k plus the 4.5k. So we're getting 15,750. Again, just to show you the comparison, in this example, we had 5,000 combined gain. And in this example, we have a 15,000 combined gain. So this is 3 times as much basically gain is what you're getting. And then we had 4 properties though, not just one. So now we've got 15.75 multiplied by 4, which is £63,000. So instead of having a £20,000 overall gain, you're having a £63,000 overall gain, which is, 315% of the £20,000 gain. So this is the reason why Prash is suggesting to people sell up, because although you're going to have to pay some tax, overall, over the space of 10 years, you're going to be way better. Imagine getting this £63,000 per annum gain. Over 10 years, you've got £630,000 gain. If you're getting 20 grand instead, as we are in the London flat analogy, 20 grand, over 10 years, you only made 200 grand. So ultimately, I know some people say, oh, well, there's not much difference between losing 2 grand and making 4 grand. But there is a big difference between making 20 grand overall and making 200 grand over a 10-year period and making 630 grand over a 10-year period from the same initial investment that you've got in both examples, which is £300,000.
Your portfolio starts to pay for itself as it's growing, because the idea is you have your initial investment and then obviously you can release equity and go and buy more. And I think one of the things as well is people always forget with limited companies, there is a little bit more flexibility. There's other expenses you can run through your limited company to save on taxes. You can do things like electric cars, pension payments, life insurances, relevant life insurance. There's trivial benefits. Obviously, that's holding.
These are important. Let's just talk these through just very briefly. So, here's the example that I had, Prash. Imagine if I wanted to buy, when I bought my laptop, it's an Apple MacBook Pro laptop. It was £2,400. So it's £2,000 plus VAT. Because I've got a trading company that's VAT registered, I don't have to pay the VAT. I can claim that back from the government. And then because to make the maths easy, the corporation tax now is 25%. So that means that I get that corporation tax relief as well. So instead of paying 2,000, I'm actually personally only paying £1,500. Whereas if I was a higher rate taxpayer, I think I worked out £2,400. I'm going to have to earn £4,000 of income to then get taxed 40%. To then get paid the £2,400. So it's like, if I buy within a limited company, it costs me £1,500. If I buy it in my personal name as a higher rate taxpayer, it's cost me £4,000. That's a big, it's more than double the price basically.
No, it's a huge difference. And I think this is something that I understand that the general public, if you're not in the accounting field or your space, you understand this because you've been doing it for so long. If you're not in this space, you wouldn't really understand it. This is why it's so important to, if you have an accountant, ask the questions. If you don't have an accountant, obviously reach out and we can kind of guide you through this. Think about the best way to structure your property purchase. But yeah, there's just so much more flexibility with a limited company. You potentially might not pay any corporation tax because you could take all your profits and just put it into a pension. What are you doing? You're benefiting your future self. Ultimately, you can still grow a property portfolio without keeping the rental profit in the company, because based on the capital growth that we see, give it 6-7 years, you could release equity and just go and buy more. So it doesn't matter if you haven't got cash in the bank, you'll just release the equity and go and buy more. And what does that then lead to? Actually, it leads to you generating more profit again, it gives you more options.
Mm.
Whether you hit your 60K lifetime, your pension limit, like you said before, electric cars, relevant life insurance, whatever it is, you might just
Can we just talk about these numbers, because I think it's important, like, to understand how much this could actually be. So electric car, for example,
yeah.
what's that going to be? So let's say £500 a month, something like that.
It depends on the car you buy. You could get something for less than that if you're not too fussed about what you're driving.
Well, let's just say I'm just trying to think about what costs I could potentially put through the company. I'm saying if I bought, I don't know, Tesla or something like that, it's probably, I don't know, £750 a month, something along those kind of lines, I reckon.
Well, let's go with £400 a month. We've got rental profit of 5.5, so
Okay.
4.8K a car cost per annum. It reduces your rental profit down to 700 quid.
Yeah.
You've not had to pay for that car out of your taxed income. Yes, there's a benefit in kind. It's quite minimal at the moment. It's 2% of the value of the car, and then whatever your tax rate is, you pay that. It's going up to 5% by 2028, but the benefit still outweighs the cost. It
Yeah.
still makes more to do it. And it's a brand new car. It's serviced. It's 3 year lease, not 2, 3, 4 year lease, whatever you decide to go with. Or you might decide to buy it outright. If you're willing to inject more money into your company, I personally wouldn't advise to do that. I think
Well,
leases
what we're
generally.
saying is buy the house, generate the income, and then pay for the company through the income, isn't it?
Yeah.
What else can we put through the company? Just give us an idea. You said relevant life insurance.
Relevant life insurance, which would be massively important with this kind of a business. I'm sure most homeowners or people who own property as landlords will have life insurance. Ultimately, what does that cover you for? If you, in the worst case, you dying, somebody will get a payout. Normally, people try to cover themselves for at least their total debt value so that their loved ones don't have to struggle when they're no longer here. Now, life insurance versus relevant life insurance, I won't talk too much about it because I can't sell it and I'm not giving any advice here, but basically they're very similar products. It's just that one can run through the company, you get tax relief on it. I'm not sure whether it costs a little bit more. That's where you need to speak to a financial advisor. But again, if it's something that you can stop paying for through your taxed income and shift it into your limited company, and it covers the debt for your limited company plus your personal mortgage, it's a no-brainer. And if you set the policy up, then it pays into a trust, falls outside of your estate for
Yeah.
inheritance tax purposes. There's so much to think about. I think long gone are the days where it's just a case of I need to buy property and grow, 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 grow. Now there has to be a strategy behind it. Like, what am I trying to achieve? And another big thing we see at the moment is you see young parents with children who are under 18. The question is always, can I put them on as shareholders? Answer is always no, because they're minors. But ultimately, as they get older, we can look at options. There's things like freezing the share value. So whatever if let's say you and your wife set up a company, Shiv, and you build up to a portfolio value of 1 million, and then your children are 18, the value will get frozen at £1 million. So your estate effectively gets frozen at that point. You can introduce your children,
Yeah.
look to shuffle the structure around, however we want to do it. But you're capping your value.
Mm,
Now,
mm.
yes, somebody will have to pay tax on that. We're not trying to do this to get out of paying tax. Ultimately, if you're making money, there's tax to be paid. If your asset portfolio value is growing, there's tax to be paid. But it's all about minimizing as much as we can.
And we're saying, electric cars, relevant life insurance. We just talked about the example of laptops and iPads and stuff. If you need that to do your work, you said about the shareholders. Whilst you might not be able to get your children who are minors to be here, but if you're, for example, if your wife, your partner is looking after the portfolio, your husband is looking after the portfolio for you, and they're a lower rate taxpayer, then they can add extra income to theirs at the 20% rate rather than at the 40% rate or whatever. So there's other ways that they can do this.
It's quite interesting that actually you mentioned husband and wife, and we won't try to make this sexist, but I had a conversation with someone the other day who basically his idea was I wanted to keep growing this and growing it and growing it so that my wife doesn't have to work. I will just pay her a salary through the company.
Mm.
Ultimately, he's retiring her, but it's like I'd rather just because this is what she wants to do as well. By the way, it's not a 1950s husband saying she has to stay home and do all this and that, but that's what their plan is. And again, that it can work. There's no reason why it can't. If imagine you're in a relationship where one's earning 150K and one's earning, let's just say £30,000, it won't take you long to get that £30,000 earner. to a point. I mean, we're talking 5, 10 years, but that's not that long in the grand scheme of things. To get to a point where they don't necessarily have to go out and work, they can earn an income and salary through an investment property company. People don't see that. People think, oh, it's rental, so you can't have a salary from it. But again, this is the whole limited company structure.
And also, property is one of the only asset classes where you can actually earn a regular passive income. You can't do that with a lot of other investments. I think one of the videos that I've done elsewhere is called "How to Win at Life," and it basically explains how you take 200 grand, you invest that into three properties today, and then over 5 years you take the rental return plus the equity growth, and you refinance the property and you buy another three properties without any more of your own money invested. You now got a portfolio of six properties, and then again another 5 years you do the same thing again. So now you've got a portfolio of 12 properties, and each property will give you a £500 a month net cash flow, which is 6 grand a month. So when we talk about 72 grand a year, we talk about 30 grand and retiring someone who's on 30 grand. If you put 200 grand in right now, over a 10-year period, you could easily generate something like 72 grand a year. Plus, you'll have 12 properties that are worth, 300 grand each. That's a £3.6 million property portfolio, all from an initial investment of just 200 grand.
Yeah, yeah, yes, it's a lot of money. We're not doubting that. But if you're in a position right now where you could, I think what's important actually people do is look at their position, see what actually the outflow inflows are. Are you down cash flow or are you up on cash flow? Ultimately, if you're up, okay, it's a good thing, but could you be even more up? If you're down, then yeah, you need to reconsider because you're not. I don't see this changing anytime soon.
When you say if you're down, basically what you're saying is if you look at your accounts and you're making a loss every year, although
Yeah.
there's some sentimental value in like holding on to properties that you've held on to for 2, 3, 4 years, it may be worthwhile you saying, do you know what? The reason I invested, the reason anyone invests is for return. And over a 10-year period, if I'm going to make, as it says here, three times as much return investing in a limited company in the northern property market rather than just sticking with what I know, it might well be the right thing to do. Um, yeah.
I had an example actually. This one you'll quite like the sound of. So he has a property that they live in, and he wants to sell it and start renting so that he can get into property investment because he wants the next house he buys. He said it's going to be my last house. So he knows it's a 5, 10 year process, but he's like, I want to get into this, buy, let them grow in value, let the rental profits sit in the account, just keep increasing the portfolio and then get to a point where he's generating enough to go and get that dream house that he really wants. What him and his partner really want. And again, look, a lot of this is down to each individual's basically what they want in life. What are they trying to achieve? But I think that's a key question. Is like, what are you trying to achieve? Because if you're trying to get to a position where you can buy a nicer home to live in, or you're trying to buy a business, or you're trying to do this, whatever it is, if you're losing money every year, you're getting further and further away from your goal.
Yeah, yeah. Really good. And I think that, people who are watching this, there'll be a lot of people who sit there and go, let me go and check this. Let me go and check whether I'm actually making a loss and stuff. Because, people who are making 150 grand a year, they just give it to their accountant. The accountant does all the bits and then they don't really look at it. So maybe it's worthwhile, having just done the tax returns. I'm sure a lot of people will be like, have their tax returns fresh in front of them. They can go through it, have a look at what the rental profit was and have a look at that. And there'll be a lot of people who have properties in London. If you do, and you find yourself in this situation, feel free to comment on this, and let us know what your situation is, and we'll be more than happy to get in touch with you. Prash, that's been really, really good. Any final sort of comments to that conversation?
No, like I said, I think just speak to your accountant. If you don't have one, reach out to us and look. The initial conversation is always free. We can just work out what your position is, because ultimately that's kind of the first hurdle. I know it's quite scary sometimes. But we don't bite. Feel free to reach out and I'm sure we can definitely help you.
And I think one of the great things about what you said, and you said it all the way through this conversation, it's not just a case of let's go and do this for you. It's like, what are you trying to achieve? Let's really get into understanding what you're trying to achieve, and then how can we structure this portfolio in such a way that benefits you and minimizes the tax that you're paying.
Yeah. No, it always has to be that way.
Fantastic. Brilliant. Thanks so much. Really appreciate it. Yeah, I'm sure we'll see you again soon.
No, definitely. Thanks a lot for having me, Shiv.
Perfect. Thanks, guys. See you soon.